Welcome to the second edition of On Air with Funded. My name is Jonathan Caulton and I'm head of the Maples London Finance Practice.
And I'm Julia Cornett, a finance partner here in our London office.
So Julia, a large part of our finance practice here in London is Cayman Islands fund finance transactions.
That's right, Jonathan, and this year is looking to be even busier than the last. Our clients continue to look at sublines, NAVs, GP and hybrid facilities across their Cayman Island fund structures.
An interesting development in the market is the publication of draft ratings methodology for subline finance facilities by Fitch Ratings. This is potentially good news, as it should help widen the lender base and ease supply-side constraints as some existing lenders in the market face concentration limits, balance sheet capacity and risk-weighted asset requirements.
Fitch's proposed methodology will assist market participants to assess the credit quality of the subline facilities by analysing each level of the financing structure, being the manager, the fund, and its limited partners, through three key ratings criteria. As a key input, Fitch will analyse the LP base forming the collateral pool to determine credit quality. They will look to public or private ratings assigned to the relevant LPs. And where an LP rating isn't available, Fitch will classify the LP based on its entity type. They will also look at other factors such as the entity or its parents, assets under management, operating history, and Fitch will then assign a tiered rating to each LP. Fitch will also look at the LP concentrations within the collateral pool and will adjust the rating based on certain exposure percentages.
Also, as part of their rating methodology, Fitch Ratings produce a QRI, a quantitative rating indication, which will analyse and model default behaviour within credit portfolios. The main inputs to this model are LP ratings, as Julie just outlined, LP uncalled capital commitment amounts, facility terms, the funds and the LP's jurisdiction. The model's main assumptions are around LP capital call defaults and recovery rates on such defaults, as well as any potential losses.
When assigning ratings, Fitch will also make a qualitative assessment. Fitch will consider the fund's manager, for example, its resources and scale, fundraising capabilities, historical performance. They'll also look at the fund itself, such as its strategy, performance, percentage already funded, and capital call default remediation provisions. They will also look at the terms of the subline facility itself that would influence an LP's incentive to meet their capital calls, such as financial covenants, security over the collateral, margin, maturity, and any FX risk. Fitch will take all of these factors into consideration in order to adjust or cap the rating.
The rating will also be under surveillance, so after the initial rating it'll be reviewed at least annually and in line with any updates to the collateral pool, changes to the fund's documentation, facility terms, or to the manager. Ratings will also be reviewed on an ad hoc basis, for instance, if the macroeconomic environment changes.
It is certainly an interesting development in the European market, Jonathan.
Yes, it could be very meaningful, as subline origination is now a very large market, having grown significantly from about $400 billion in 2017 to around $750 billion in 2022. The ratings could helpfully open up the door to potential capital market structured finance exits into the secondary market. This can be really helpful at a time when banks are increasingly focusing on their capital adequacy requirements with the Basel IV reforms.
We will be joined by members of our global fund finance team at the upcoming Fund Finance Association Summit at the Belfry, and later this year at the London Symposium.
Yes, we very much look forward to connecting with everyone in the coming weeks.